Welcome to this presentation of NAIFA's Limited and Extended Care Planning Center. Today we are broadcasting a webinar entitled The Evolution of Life Settlements to Help Seniors Pay for Senior Living and Long-Term Care. I am Brendan Burnett, NAIFA's Director of Professional Development, and with me today is Chris Orestes. Chris is the Executive Vice President of GWG Life, one of the largest secondary market buyers of life insurance policies in the market, and a publicly traded company on NASDAQ. Chris is an author, speaker, and nationally known industry expert, and he has been in the insurance industry for over 20 years, first in Washington, D.C. as a lobbyist for the life and health industry, and then as the founder and CEO of Life Care Funding, where he pioneered the use of life settlements as a tool to pay for long-term care before merging his company with GWG. Chris was the first to introduce life settlements as a long-term care funding resource over a decade ago. And Carol Golden, Executive Director of NAIFA's Limited and Extended Care Planning Center. Chris, welcome.
Well, thank you. Thank you, Brendan. Thank you, Carol. Always a pleasure to be working with NAIFA and the LECP. We're proud to be a participant and sponsor of the initiative, and think it's a great opportunity to be educating agents and advisors about other ways that they can help families pay for senior living and long-term care. And one of those ways that has been growing considerably over the last few years is the use of a life settlement as a tool to fund long-term care by using a life insurance policy that might otherwise be lapsed or surrendered, and instead getting its secondary market value through a life settlement and then having tax-free funds to work with to pay for long-term care. And what I want to do is, over the next 20-30 minutes, spend time taking you through how that looks, how that works, and how you can bring it into your practice as a tool in your toolbox, as a way to help your clients as they struggle with the unique costs that come from aging, particularly exacerbated by the need to fund long-term care. Let's start where it begins with a silent crisis around long-term care, an issue that people just don't want to be talking about. It's an issue that people are misinformed about, they ignore, they all think it's never going to happen to them until one day it does. And then they're in a crisis mode, and it's driven by a failure to plan. Just far too many people in this country are planning adequately for what is coming down the pike for so many of them, because the reality is 70% of people that are age 65 or older will need some form of long-term care. And the big question everybody asks is, how do we pay for it? People don't understand the differences between Medicare and Medicaid, what's covered by private pay, what the differences are between a nursing home and assisted living community, home care. And for so many people, one of the ways that they go towards quickly to try and fund their long-term care is trying to qualify for Medicaid and getting onto Medicaid assistance. And for those that do, they discover there's a pretty strenuous spend-down process. The requirements financially to qualify are you have to be at the poverty level or below. And so assets begin to count against you. And one of those assets that counts against people is a life insurance policy. It's a non-qualified asset for Medicaid eligibility, and almost 40% of people who apply for Medicaid still have a life insurance policy that they have to contend with as part of their eligibility process. But when you look at the broader market when it comes to private pay, when you consider the fact that there are less than 8 million active long-term care policies in this country today, despite all of our best efforts to inform and educate people about the importance and the need for planning and the use of a long-term care insurance policy, still at this point we have less than 8 million active long-term care policies in this country. By comparison, there's over 150 million in-force life insurance policies in this country today, with over $12 trillion of in-force face value. Now the problem is, 9 out of 10 of those policies are in danger of being lapsed or surrendered. There's a very high lapse and surrender rate for life insurance policies. So many people who buy life insurance policies ultimately will not keep them to collect a death benefit. They will be abandoned along the way. In fact, almost $685 billion of death benefit was lapsed or surrendered in 2017. Now, of that population, seniors make up a big portion. And on an annual basis, $230 billion of life insurance policy death benefit is owned by seniors who could potentially qualify for a life settlement and turn that policy into its highest secondary market value instead of lapsing or surrendering. When you look at the size of the life settlement market today, it's growing considerably. In fact, think about it. So many of you have seen the TV commercials on cable advertising for people who have a life insurance policy to sell it instead of abandoning it. Well, in 2018, we saw $3.8 billion of life settlement transactions completed. And that was a 28% increase over 2017. So this is a growing market that in 2019 and heading into 2020 will continue to grow. Question is, as advisors, how do you put this into your practice? How do you use life settlements? How do you feel comfortable with it and then access the life settlement solution? Well, let's spend some time talking a little bit more about how the life settlement solution can work. And let's take a minute to visit with a case study. This would be a pretty typical life settlement candidate. Somebody, in this case, 80-year-old female with impaired health, who owns a universal life policy, $1 million death benefit, $30,000 of annual premium, and $20,000 of cash surrender value. It's a pretty typical scenario that we would see. Well, based on these stats, as a general hypothetical, this person might get 20, 30, maybe even more percent of the death benefit. In this case, let's call it $300,000 of death benefit, that $200,000 to $300,000 of life settlement value in exchange for their $1 million death benefit would not be uncommon. So who qualifies for a life settlement? Well, somebody who is 70 and above is your typical candidate. We see the range of life policy holders that do life settlements, the sort of the bulk of the population being between the ages of 75 and 89, and they all share in common that they are impaired in their health. In fact, when you're thinking of a life settlement, think of reverse underwriting. This is the opposite of when you buy life insurance. The younger and healthier you are, the better you'll do. But in the case of a life settlement, it's the opposite. It's the older and sicker you are, the better you'll do with a life settlement. So this is a program, an option that is ideally suited for senior clients experiencing health conditions and moving in the direction of needing long-term care. They have a life insurance policy, and they're at the age and they're at the health status where they become a viable candidate to use this option. The most typical types of life insurance policy that we're going to see in the market is either a universal life policy or a term life policy. A convertible term life policy is preferred, but a term policy beyond its convertibility period is also acceptable. And any form of life insurance will qualify. It's just that universal and term are going to be the two most common forms that you're going to see and will be eligible for a settlement. Typically also, it's going to be a minimum of $100,000 of death benefit or greater. So any policy below $100,000 of death benefit value, it would be very uncommon for it to find value in the life settlement market. So let's talk about one of the options that has emerged in the settlement world over the last decade. And I can say that I'm proud to have been the pioneer who brought this concept into the market now over a decade ago. And it's something called a long-term care benefit. And it's, in essence, it's an irrevocable bank account. Think of it like a long-term care health savings account, like a long-term care HSA that's exclusively funded by the life settlement. So somebody has, in the example that we showed you, somebody had a $1 million life insurance policy, they get $200,000 or $300,000 of settlement value for it. This long-term care benefit is available to them as a free option if they want to park the money tax-free and then have it administered towards their care needs on a monthly basis. It makes monthly payments to any form of senior living or long-term care somebody would want at whatever amount they need to whatever form of care they want, and it's flexible and adjustable so it can change to match the care needs as those evolve. You might start out in a home care environment for $1,000 a month and then need to move into a senior living community, and now you're going to need $5,000 a month. Well, with the benefit account, that's not a problem. You just put a change notice into your account, and from 1 month to the next, it will change the amount and the direction to where the money is being spent at the person's direction who owns the account. Important to point out, this is not to be confused with long-term care insurance. This is not long-term care insurance. This is not issued by a carrier. It's a private bank account. Again, an irrevocable bank account like a long-term care health savings account. What's nice about it not being insurance is there's no wait periods, there's no claims. It's simply once you fund the account with the settlement, those funds then are immediately available to be used in whatever way you want. And quite frankly, you can even mix and match the use of the funds. You could maybe take part of the money as a lump sum cash settlement and then put part of the money into the account. So it's really designed to have maximum flexibility to meet the needs of the family when they're trying to contend with the requirements that they have from funding long-term care. Also, with every account, there's a final expense retained death benefit portion that's held for the family. So a small portion of the account is always preserved for the family to the very end and then released as cash to the family at the time of final elimination of the benefit. Also, if the person who is a beneficiary of that account passes away before using all the funds in the account, those funds will then pass to whoever has been named as the account beneficiary, which can be one or more people. And it will go to them tax-free because as long as they're under the estate tax threshold, the funds become part of the estate and will pass tax-free to whoever's been named as the account beneficiary. And the funds go into the account tax-free to start with because the person who's using the account has been diagnosed through underwriting as either chronic or terminal. And the HIPAA exemption for that allows then for tax-free treatment of the life settlement funds. The long-term care benefit is tax exempt for both the family and the beneficiary of the account. And it qualifies as a Medicaid qualified spend down because the funds come from the sale of the asset, the life insurance policy, at its fair market value, and then they are sequestered in the account and used exclusively for long-term care and healthcare related expenses. This keeps the person who's using the benefit account private pay for as long as possible. So as long as somebody has funds in this account and they're using it towards their care, they're private pay. They are not on Medicaid. But once they have spent through and spent down the account, they could make a seamless transition over to Medicaid. Now, this long-term care benefit account and the use of life settlements overall as a tool to pay for long-term care in senior living services has been accepted by every provider of care in this country for over a decade. Groups like Brookdale Senior Living, Sunrise Senior Living, some of the biggest home care companies out there, A Place for Mom, they all use this as another one of the tools in their toolboxes to help families pay for care. So when an advisor is able to team with them and a family to use this strategy as a way to pay for care, you'll find that the care providers are actually very used to it, and they all accept funds that come from the benefit account and will set up the account to transfer funds on a monthly basis to provide for their services. So how does a life settlement even exist? What is the basis for which the owner of a life insurance policy can sell that policy to a third-party buyer? Well, it starts over a century ago with the United States Supreme Court, and they're ruling on a case, ironically, that was about healthcare. The Grigsby versus Russell case was decided in favor of the policyholder who had signed over his death benefit in exchange for healthcare services when he was requiring care from a doctor. This then was upheld in court to establish that a life insurance policy is actually legally protected as the personal property owned by the policyholder, which conveys to them the same personal property ownership rights as a person who owns a house or, say, stocks and bonds. In fact, it's a really good way of looking at this. A life insurance policy and a home are considered the same kind of asset. And with a home, you make payments, mortgage payments for years on your life insurance on your home. And then just like with a life insurance policy, you're making premium payments. Now, after years of making those mortgage payments, would you just abandon your home without selling it? Of course not. You're going to sell the home for its market value, and you're going to work with professionals who know how to access that market to complete that transaction. Well, with a life insurance policy, it's the same thing. After years of making premium payments, why would you throw away a policy when there are professionals you can work with to access the market to find out what is the full market value of that asset before you would let it go? This is also a very well-regulated, stable market. For some people, they remember life settlements from 20 years ago and think of it sort of as a Wild West type of transaction. But that has changed over the years as states have adopted NAIC model regulations across the country. In fact, there's only 5 states now in this country that don't have NAIC model regulations on the book, establishing consumer protection, disclosure requirements, licensing requirements, compensation requirements to protect both the consumer and the agent. This is a very mainstream, stable, well-regulated market that any agent can feel comfortable working with their client to access. Taking the regulatory aspect of it a step further, just 2 years ago, the NAIC issued a white paper where they talked about market innovations with insurance to help the consumer pay for long-term care. And in it, one of the primary options that they talked about was using a life settlement to pay for long-term care. And in it, they talked about the long-term care benefit that we've been discussing as an option that clients of agents could look to help them position their money correctly, protect it to be used in an optimal way to cover their costs of senior living and long-term care. Just at the end of last year in Congress, taking it even a step further, members of the House Ways and Means Committee introduced a bill to officially create in the IRS tax code a long-term care benefit account, that long-term care HSA concept, to officially codify it in the tax code so that anybody who does a settlement, regardless of their diagnosis, whether they're chronic, terminal, or not, would all be able to have the same tax-free advantage using this as a way to pay for long-term care needs now or in the future. It's predicted that this could save billions of dollars to taxpayers by delaying the need for people to go on to Medicaid and extending their ability that much longer to remain private pay. Tax treatment for life settlements breaks down a couple of ways. One, if you are chronic or terminal, chronic, 2 ADLs or more, or terminal, a certified terminal diagnosis, then the proceeds from a life settlement are tax-free. If you're not chronic or terminal and you do a life settlement, let's say your life expectancy is above 2 years, the typical range in the life settlement world is between 2 and 10 years. That's sort of the viable area when it comes to remaining life expectancy to find value in the marketplace. And if you're in that category, 2 to 10 years, then the funds from a settlement would be taxed as capital gain for anything above basis in the policy. Basis being what you've paid in premiums. So if you paid $90,000 in premiums over the lifetime of a policy and you received $100,000 in a life settlement, you'd be looking at a $10,000 capital gain. Unless you're diagnosed as chronic or terminal, then it would all be tax-free. It's also important to point out that there are cases on the books now where policyholders have sued their advisors and insurance companies for keeping information about a life settlement away from them. And this is important to point out. We have 3 court cases that are established precedent now on the books where somebody let go of a policy, either they lapsed it or surrendered or a partial surrender, and then later came to discover that that could have been used for them in a life settlement and could have been deployed in these instances also towards their long-term care needs. court cases were then brought up and settlements had to be reached. These court cases are on the books now, and agents really need to be cautious about ignoring life settlements and the possibility that a client could come back later down the road and hold them responsible for them squandering an asset that had tremendous value for them, finding out after the fact. So when it comes to the settlement world, there's a couple of ways that agents can be successful bringing this into their practice. One is the retail opportunity to add this to your practice on a daily basis. In what you're doing when you're talking to your clients, marketing your programs and services, whether it's online, doing seminars, in marketing materials, whatever the case may be, you're in a position with life settlements to be able to add another tool now, another opportunity, particularly to help senior clients or families of clients that have senior parents that might be in the position that they're struggling with the cost of care. Now you can add this to your practice as another way to help people pay for care. On a wholesale basis, you can also add this to your practice by analyzing your book of business. And companies like ours will help analyze a book of business and identify policies before they're lapsed or surrendered, and then work with you to reach out to and help clients understand this option before they would let a policy go. So there are ways to bring this into your practice, particularly when you're working directly with buyers such as us who can help you, just like a carrier does, help you bring a insurance product out into the market. We can help you bring a settlement product out into the market and make it a key part of your practice. So as I conclude, and before we take on any questions, I just want to end with these thoughts for you. Remember, when it comes to using settlements, particularly as a tool to help people pay for long-term care, you're creating new value from a policy, an asset that is already owned and quite possibly being overlooked. This is something that people have made payments on for years. They've invested a lot of money into a life insurance policy, and whether it's a term policy, a universal life policy, whatever the case may be, this is a way to create new value from a policy that is in high danger of being lapsed or surrendered. A new way to fund retirement and particularly long-term care needs. This is for people who are not going to qualify for any other insurance product. The people that qualify for a settlement are going to be automatic declines for anything else. They're going to be people who might be looking to go on claim if they still do, in fact, have a long-term care insurance policy. So that is the market, a new funding tool to help a market that has very limited options if they've failed to plan and they now get to a point where they're in a crisis mode. This is also a way to take old business and turn it into new leads. This is a new area for you as an agent to go back to clients and have a new discussion, a new value proposition you're putting on the table, and through all this, a way to add another revenue stream to your practice. By using settlements as a tool to help clients with their retirement and long-term care costs, you're adding another revenue stream to your practice. And I know every agent out there would welcome the chance to add another six-figure revenue stream to their practice. And we have many we work with that have not had to do much work in adding this to their practice, yet have built a thriving new area of practice and revenue for them, and a great new area of solution for their clients. So with that, I'm going to stop and open up to see if there's any questions coming from our participants in today's webinar.
Okay, well, let me start off the questioning myself, Chris, if you will. I'm gathering from this that I know that I have seen a lot of clients who, let's say they have a parent, and because they can't afford to fund the parent's needs, they've had to look at the assets of the parents. And as you said, when you find the life insurance will disqualify them for Medicare to a degree, and here they have this policy that might serve to help the entire family from not being able to get the kind of care that they want for that parent. One of the questions that I have heard some of them ask is, how long has life settlements been used for funding long-term care?
That's a great question, Carol. Life settlements has been available to people going back really to the 80s is when it first emerged in the market as something beyond a curious court case going back to 1911. But its use for long-term care funding as a specific practice area has been now 12 years. It first emerged back around 2007 in the market, where it was actually care providers. It was assisted living companies, nursing homes, home care companies that realized the value of this as another way to help people fund care, because they have worked with the Veterans Aid and Attendance Benefit. They've worked with reverse mortgages. They've worked with annuities. And then all of a sudden they realized, wait a minute, as this option started to come into the market, what a great match it was to help the people they were trying to help afford care. So we're talking about over a decade now, and it just steadily growing year after year. Support from organizations now like the NAIC, acceptance with every care provider across the country. So this is really the time is right. If somebody hasn't added this to their practice yet, this is well established, over a decade, and good timing now to bring it into their practice as it continues to grow as a mainstream financial tool across the country.
And if they are interested in adding it to their practice or have more questions, although I have to say the slides were very informative, they can visit at lecp.nafa.org, and they can reach you directly via the NAFA long-term, I shouldn't say that, the NAFA LECP Center.
That is correct. My contact information, and there's additional information. We've posted videos and articles, papers, white paper that's available. That's actually available for anybody. Any NAFA member can download for free. So great information. Contact information is all there. Reach us through LECP, and we are standing by to work with any of our agent friends out there looking to help their clients and add a new tool to their practice.
Chris, how does this impact Medicaid eligibility?
Good question. This is interesting because it's actually this meets the exact definition of what a qualified Medicaid spend down is. When somebody has an asset and they're inside the 5-year look back period for Medicaid eligibility, the asset has to be dispositioned correctly in their estate. And I'll give you a good example. Let's say you had a second home, a camp on the lake or the ocean, and you wanted to transfer it to your kids and go on to Medicaid, and you sold it to the kids for $1. That would disqualify you from Medicaid eligibility. Any asset has to be disposed of, sold for its fair market value. You can't transfer the ownership of a life insurance policy to your kids for $1 either. So by selling the life insurance policy through the life settlement, you are getting its full, fair, secondary market value. And then the funds are not being squandered. The money isn't then being used to go on a world cruise, come back 8 months later and jump on Medicaid and go into a nursing home. The funds are going into a protected account, which is making payments directly to the care provider on a monthly basis. So when we built the long-term care benefit, we worked closely with both long-term care service providers and long-term care regulators to make sure it would have the tax-free status and the Medicaid qualified spend down status. As long as you're using the account, you're private pay. And there's a big difference between the care experience somebody gets when they're on Medicaid versus when they're private pay. When you're private pay, you can choose whatever you want. You can stay home, you can go into a beautiful senior living community, and I'm going to tell you there's some beautiful ones across this country that if you went and toured for the day, you'd want to move in yourself. I mean, the food's incredible, the social activities, there's some amazing places, but Medicaid doesn't pay for that. Medicaid primarily is paying for nursing home care, and that's a big difference from private pay. So the goal for every advisor out there and every person who's looking at care is not how do I rush onto Medicaid as quickly as possible. It's how do I use my assets to the best of my ability to stay private pay for as long as possible. And with this approach, you're able to do that.
And we have time for one final question. Does this compete with long-term care insurance?
You know, it doesn't, and that's another really good question and an important nuance. In fact, it is very complementary to long-term care insurance in a couple of ways. One, think about this. Anybody who would qualify to buy long-term care insurance will not qualify yet for a life settlement. Vice versa, if you are an eligible candidate for a life settlement, you are an automatic decline for not only long-term care insurance, but life insurance, anything else. Anything other than a medically underwritten annuity is about the only other option you'd have. So what we see happen a lot is actually there are people that will approach us about using the program that own a life insurance policy and a long-term care insurance policy, and they'll use it together. So they have a long-term care insurance policy paying out their monthly benefit. They'll also settle their policy and turn that into funds to supplement any other costs or anything else that it is that they might want to do beyond what the long-term care insurance policy will cover. So not only are they not competitive to each other, they're actually very complementary.
Well, Chris, I want to thank you for giving us so much information. As you know, the LECP Center stands for the Limited and Extended Care Planning Center, with the emphasis on planning. And sometimes people just fail to plan. And it seems to me that the life settlement opportunity in the secondary market sometimes can give people an opportunity, especially when crisis is upon them, to turn around and look at their assets and have another planning tool in their tool chest. So I want to thank you for, one, taking us through the history so that we can understand the evolution of this secondary market, and for all the valuable information you have shared today. Thanks again.
It's very much a pleasure and a great pleasure and honor for us to be working with you and LECP and all the amazing members of NAFA.
Thank you.